Hello and welcome back to Goodwill Wealth Management. Today, we have an exciting topic for all you budding investors out there. We're diving deep into the world of value investing. If you've ever wondered what it means to invest in value, how to spot undervalued stocks, or why legendary investors like Warren Buffett swear by this strategy, you're in the right place. So, let's get started with what is value investing. Value investing is a time-tested investment approach that has been used by some of the most successful investors in history. It's all about finding and investing in stocks that are trading at a price below their intrinsic value. To break it down further, value investors believe that the market sometimes misprices stocks. So, they search for those hidden gems, stocks that are temporarily undervalued, and aim to buy them at a discount. But why does value investing matter? Well, it offers several advantages, including 1. Lower risk. Investing in undervalued stocks can provide a margin of safety, reducing the downside risk. 2. Consistent returns. Value investing focuses on the long term, aiming for steady, reliable returns. 3. Emotional discipline. It helps investors avoid the emotional rollercoaster of the stock market, as they rely on fundamental analysis rather than market sentiment. Key principles of value investing. 1. Intrinsic value. One of the core principles of value investing is determining the intrinsic value of a stock. This is the true worth of a company based on its fundamentals like earnings, assets, and growth potential. Investors use various methods, such as discounted cash flow analysis, to estimate intrinsic value. 2. Margin of safety. A margin of safety is a crucial concept in value investing. It's the difference between a stock's intrinsic value and its current market price. Value investors aim to buy stocks with a significant margin of safety to protect themselves from potential losses. 3. Long-term perspective. Value investing isn't about quick gains, it's a patient approach. Investors often hold onto their stocks for years, waiting for the market to recognize the true value of the companies they've invested in. 4. Fundamental analysis. Fundamental analysis is at the heart of value investing. It involves studying a company's financial statements, competitive position, industry trends, and management quality to assess its long-term potential. 5. Contrarian thinking. Value investors often go against the crowd. They buy when others are selling and sell when others are buying. This contrarian approach can lead to finding excellent investment opportunities when the market is pessimistic. How to get started? 1. Research. Start by researching the basics of stock analysis, financial statements, and valuation methods. Books like The Intelligent Investor by Benjamin Graham are excellent resources. 2. Stock screening. Use stock screening tools or platforms to identify potential value stocks. Look for companies with low price-to-earnings ratios, strong balance sheets, and a history of consistent earnings. 4. Diversification. Diversify your portfolio by investing in a variety of value stocks from different industries. This helps spread risk and can lead to more stable returns. 5. Patience. Remember, value investing requires patience. Don't expect immediate results. Stick to your investment thesis and avoid making impulsive decisions based on short-term market fluctuations. In conclusion, value investing is a strategy that can potentially offer you solid returns while minimizing risks. It's a method embraced by some of the most successful investors in the world. If you're willing to put in the time and effort to research and analyze stocks, value investing might be the right strategy for you. Thank you for joining us. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and hit that notification bell, so you never miss an update. And as always, feel free to leave your questions and comments down below. Happy investing!